Looks like we're out of time, so let's go ahead and get started. My name is Chinda Chun, and I'm with NACV and the Consultants Training Institute. I want to thank you all for joining us for the Around the Valuation World International webcast for today, November 20th, 2023. Before we get started, I'll just go over a few items again. If you have a CPE subscription to Around the Valuation World International, please respond to all the poll questions that pop up on your screen for CPE credit. CPE certificates will be available on your NACB.com portal within 7 to 10 business days after today's webcast. If you have any questions for the presenter today during the webcast, please use the Q&A feature in Zoom, as those will be directed to the presenter and Wolfgang. If you have any questions about NACB or technical questions, please use the chat feature, as those will be directed to me. All right. And then we have Wolfgang Niest and Pratik Shah, who's joining us today, who are editors, and we also have Andrew Newman and Brian Jones. The two are probably unable to join us for today. Today we just have the GACBA news, which will just go over a few items, and then we'll have Peter Nyberg, who will discuss, do you really know your cost of capital? So really quick for the GACBA news, just want everybody to remind everybody that we do have our 2023 Business Valuation Financial Litigation Super Conference that is coming up on December 14th and 15th. It's still not too late to register for the virtual registration, so if you do need CP credit for any of your recertifications this year, please feel free to register that. You click on the links in the material and you'll be directed to more information about that. All right, and with that, I'm going to turn the time over to Wolfgang, who will get us started with Peter today.
Yeah, thank you. Thank you, Chanda, for this introduction. One more news from EACVA I can mention. We are very delighted that our EACVA conference this year, which will take place at end of the month in Berlin, has been fully booked for many weeks now. And at the same time, we are sad that we cannot accommodate everyone who wants to come. But let's mark the calendar for next year. Our 2024 conference will be held on December 5th and 6th in Düsseldorf. And we have a much larger venue than this year, but this year with our nearly 400 attendees, it will be a great event. And yeah, so let's come to our today's session. It's a pleasure for me to introduce Professor Peter Nyberg. He is associate professor at Aalto University School of Business in Finland. His research is focused on asset pricing and quantitative investment strategy. He has published a number of papers in top-tier finance journals such as Journal of Finance, Journal of Financial Economics, and Review of Finance. And the reason why we invited him is that I have read some of these papers, and I got a hint from a member from Finland, and that was the reason I dived into his papers. And this is a very interesting topic from an academic perspective, but, and that's the reason why we invited him, maybe we can get some clues and conclusions for our practitioners' daily business valuation work. And yeah, it's a pleasure for me, and I would hand over the microphone to Peter.
All right, thanks. Let me just share my screen, so like that, and then
perfect.
Slideshow, great. You can all see it, and just gonna, soon close my video, so you can all concentrate on my voice and what I'm about to tell you. But first, of course, I want to thank the organizers for inviting me to give this talk today, and thanks also to the for me unknown Finnish member who recommended me to be here. I have my guesses actually who that might be, but nevertheless, thanks to everybody. All right, so hey, let's keep going. Let's start going. So this is joint work with Matti Keloharju, who's also a professor here at Aalto University, and then Juhani Linnanmaa from Dartmouth College. And you can probably see from this trade's name that we all originally come from Finland. So it's a gang of 3 of Finnish professors.
Peter,
Yes.
just a second. I think you have closed your video.
Okay, I can put it on. Yeah, so if it's like that.
Perfect.
Yeah. Great, yeah. Yeah, so I mean, gang of professors from Finland. And the title of my talk today, and the title of the paper that I'm referring to today is, Do You Really Know Your Cost of Capital? So, I mean, cost of capital, that's a very fundamental concept in valuation. And of course, in accounting, but also certainly, I mean, in finance. And it's of course also known under the name of expected return and required rate of return. But whenever we do valuation, want to assign a valid price for some financial object or firm, we need to know the cost of capital. But of course, many ways of trying to estimate the cost of capital, and we are not really touching on that. I mean, the best method for doing that, what we are interested in pinning down the variation in the cost of equity capital across publicly listed firms. And I mean, this is something that actually, okay, let me just see if I can. No, great. So I mean, these two are papers that basically challenge the conventional wisdom. I'm soon going to be explaining why. So it all started with a Journal of Financial Economics paper that we published back in 2021. That was entitled Long-Term Discount Rates Do Not Vary Across Firms. And we thought after this paper was published or was accepted to the journal that, okay, so maybe we should also write a practitioner piece around this topic, because our findings might have important implications for practitioners also. So we then a while ago also published a paper in the Journal of Applied Corporate Finance, which is really, more geared towards practitioners. And so what is the conventional wisdom? Well, the conventional wisdom, at least, for me, who does finance research, is that we often assume that the cost of equity capital varies considerably across firms. Sometimes you might hear that, okay, we know, for example, from historical data, looking at average rates of returns on the stock market, that, let's say, value firms having high book-to-market ratios, they have provided historically much higher average rates of returns than growth firms that have low book-to-market values of equity. And then one, implication of this would be that, okay, value firms tend to have higher discount rates and higher cost of equity capital than growth firms. And then a rule of thumb could be, for example, that, okay, so when you then want to choose a discount rate or cost of capital for value firms, it should be a couple of percentage units higher for those types of firms than, for example, for growth firms. And of course, so we see, considerable variation, at least in empirical data, in the cost of capital across firms measured by average stock returns. In firm practice also, so if you ask CFOs across different companies, okay, so what is your estimate of your cost of equity? You also find a high dispersion in the answers that the CFOs give to this question. Also, if you check analysts, what kind of discount rates or cost of capital estimates they apply when they do their job, there's huge variation there, and so forth and so forth. But then in our original 2021 paper, we actually then make the claim that, hey, look, if you really look deep into the data, it appears to be the case that this discount rate variation, cost of capital variation, is actually much smaller than we thought. And one reason for that is, so let's assume, for example, that you calculate the cost of equity capital using the CAPM, which I'm sure all of you are aware of, the model. So let's say you then have monthly stock market data, monthly stock market returns on a given firm, and you run the CAPM regression, having the market factor on the right-hand side of this regression, and you estimate the beta. And then you, of course, take the estimated beta, multiply with the market risk premium, and get then an estimate of the risk premium equity capital for this given firm. But the fact is that actually this estimate, this risk premium that you then estimate, it's actually one period ahead cost of equity capital or risk premium for that. And of course, then the assumption, if you then use that discount rate, that cost of capital to discount back all future expected cash flows that the company will give investors use the same discount rate, well, but then basically, of course, assuming that it stays the same over time. So from year one, it will be, let's say, 8%. If beta is approximately 1, maybe 8%. Year two, it would be 8%, and year three, it would be 8%. And this is something simply not true if you look at empirical data. So we see actually that, okay, in the short term, when we look at actual stock returns, there is a fairly large variation in these expected rates of returns or cost of capital. But when we prolong this, window of analysis up to 20 years, all these differences tend to die out actually within 5 years. And of course, in firm valuation, it's not just the discount rates during the first 5 years that matter for valuation. It's discount rates from here to eternity in a sense. And if these long-term discount rates are much closer to each other across firms, and they weigh more in all valuation because you have many of those future cash flows starting from year 5 onwards, then actually the discount rate that you would use like a geometric average of the discount rates, which is like the yield to maturity. If you look at bonds, it doesn't actually vary almost at all across firms. So let's get to the basics here also. Results in brief, and then I'll talk you through some steps of analysis we have taken in these papers. So we find basically that let's assume now that the mean cost of equity capital across firms is, let's pick a number, 10%, which would then be like the expected rate of return on the stock market on an average year. What we find is then that, okay, 99% of firms listed on the stock market, they had a cost of equity within 1% of this market-wide average. That is 99% of firms, so it's an estimate, but nevertheless, 99% of firms have their cost of equity capital between 9% and 11%. So the amount of variation there is actually much smaller than what previous studies have indicated. All right, so let's see what happens here. So how do we do this analysis? Well, we use standard data from the US stock markets. So we take the CRISP, Center Research in Security Prices, stock market data from 1963 till to 2018. All firms that are listed on NYSE, NASDAQ, and Amex, or NYSE Next, what's currently called. And we do, all the basic filters that you would do in asset pricing work. So we exclude financials and all other securities than common stocks. And we also use delisting returns to take care of those firms that delist or disappear from the database over time. So we actually try to actually get the return, better estimate the return that shareholders in those cases would have finally received from the investments. And the goal that we have is that, okay, we want to approximate the cost of equity at the firm level. Now, the problem, of course, here is that, as we all know, stock market data is very noisy. There's lots and lots of different shocks that hit the stock market and different firm-specific events that affect the realized rates of returns. So one way then to minimize this noise or make this noise less dangerous for an analysis is that we create portfolios. So instead of looking at 6,000 firms, or lots of noise in those individual firm returns, we actually rank these firms, so put these firms into 300 different groups, 300 portfolios if you want. So that's the aggregation level that we are going to be looking at this thing. Now, then of course another question is, okay, so we want to model differences in cost of equity across firms. And how do we do that? Well, in the asset pricing literature, we found, or the professionals found that there appear to be fairly many different variables, firm-specific variables, such as the book-to-market ratio of firms, such as the past 12-month returns, such as leverage, whatever, that seem to predict cross-sectional differences in expected returns, or in other words, some type of cost of equity differences. So we use 55 of those return predictors to sort stocks into these 300 portfolios. in order to get at least some kind of variation in short-term cost of equity. But then we also, as robustness test, we use the French 5-factor characteristics and 3-factor characteristics, market capitalization, book to market, to see if our results are changed. Okay, so then, I mean, these are just details. I'm going to quickly talk through these technical details. So we have now 55 predictive variables for each and every firm, each and every year, that we use to sort these firms into portfolios. So one way we do it is that we standardize all these variables, and then we take an average of them, and then we sort stocks into these 300 groups based on this standardized average. And the assumption here is that, at least based on past research, that those firms that have the highest value for this predictive variable, they are predicted to have higher returns in the future than those firms that have the lowest values of this predictive variable. But then, instead of what most studies, when they do this type of analysis, they maybe hold these portfolios for 1 month or maximum 1 year. It could be 5 years sometimes, but often we're talking about like a holding period of 1 year. But what we do differently here is that we hold those firms in the same portfolios up to 20 years and see what then happens to the return differences once we go past the first year of holding period. So it's, in a sense, I mean, it's fairly easy setup to understand in this case. Okay, so you rank firms into portfolios based on all those characteristics that have been shown to predict future returns. And I mean, that also then seems to be some determinants of differences in the cost of equities. And then those firms that we have ranked, we hold them in those groups for the next 20 years and see what happens to their returns. And then we use an overlapping basically sample, they take care of all the statistical problems that might then arise from that. But we have like 24 months from each and every sort of data that we can look at. And then, of course, if we do these sorts every month, we have, let's say, about 600 observations of holding period month 110 for 300 portfolios. Okay, but hey, here's now the graph that I want you to take a look at. So now, I mean, so we have now done the sorts, and this is now the average results from these sorts. And what I have plotted here is like, I mean, the 5% of the portfolios that have the highest values, so these predictive characteristics, variables, and these are now the ones that have the lowest values, so these predictive characteristics. And you can see that, yes, it actually seems to work in a sense that it has worked in previous literature. So during the first holding period month, so this is not monthly data, but you have 20 years here, you can see that there is a huge dispersion here in these average realized rates of returns based on these sorts. And already, I mean, then here you can see that like that. So already, but then here you can see that, okay, on holding period year 3, these return differences are starting to die out. And when we get to year 5, you can see that there's almost no differences in the mean returns across these groups anymore, going up to the 20th year here. So it's basically just noise what you see here. And another way to look at this thing would be to then look at the differences between those two groups. So it starts out large. It's just, I mean, for a previous figure, I mean, I'm just looking at the difference now between those two lines. So first, I mean, there are huge differences in mean returns between those two groups or cost of equity capitals. But after year 5, I mean, there's basically nothing left once we take into account, I mean, the statistical uncertainty and I mean, these confidence bounds here. So it's basically 0. So what implications does this have? Well, let's think about it. So let's now assume that we are valuing a firm. And let's take the easiest model, like discounted dividend valuation. All right. So you will take the cash flow at year 1, a simple example, and discount it back one period. Okay. And of course, then you would basically use, I mean, the discount rate that you can see here for this. I mean, for this discount rate, basically plus 10%, so there's just differences here. If you add the market premium back here, and for the other groups of firms, you would use this discount rate. But then year 2, you would need to add or multiply this year 1 discount rate with this discount rate that will be valid from year 1 to year 2. Okay, so if you discount the year 2 cash flow with this number here, you get the discounted value at year 1, and then discount it back, of course, to the current period at the beginning of the period. Okay, and the point here is that, okay, here we find a large variation in discount rates across firms, but the more and more you add these future discount rates to these formulas, and you go, I mean, the 50-year discount factor, 10th-year discount factor, then, I mean, these numbers do not vary almost at all anymore. So what we then do is that we take, I mean, this is back of the envelope type of calculation, but we take the numbers that we have. And because the stock returns I showed you previously were like cross-sectional mean, so we took out the market mean from those stock returns. What we do here is that we assume that, okay, you know, the average rate of return on the market or the expected stock market return is 10%. It's an assumption. You can make other assumptions. And then we know that, I mean, these stocks having the highest, this group of stocks having the highest expected rates of returns. We then, I mean, add the return spread here to the 10%, and here we, I mean, then they take out from the 10% this, I mean, return spread that these low expected rates of returns group of stocks have. Okay, so these are just basically based on the numbers you saw in the previous figure. Okay, so what about this one? Okay, so this is now, I mean, discount rates you would use to discount back, annualized discount rates that you would use to discount back, for example, cash flow that occurs in year 5 to day 0, to today's values. Okay, so how do you get this, for example? Well, that would be the year 1 discount rate plus 1, it's here, multiplied by the year 2 discount rate, that's there, annualize it, take a square root of that one, then take the -1 out, and it's 3.3%, and so forth and so forth. And as you can see, because these difference in expected returns on year 20, year 21, and so forth, because they are so close to each other, we can already assume here that they are equal. And you can see that actually this discount rate that we would use, I mean, to discount back here 22 cash flow to current day, they basically are fairly close to each other for these two groups of firms. I mean, high expected rates of return firms and low expected rates of returns firms. And in year 100, well, of course, we should discount cash flows from here to eternity, basically. I mean, the difference is not that large. And finally, you can see that, I mean, when we get closer, further away in time, the discount rate actually becomes the same, basically, across both of these firms. And then finally, I mean, you can do some back of the envelope calculations. So let's assume that there's now cash flows starting at, let's say, €1 or $1 at next year. And then we can assume that, okay, growth rate might be 1%. So here it grows by 1%, and here it grows by 5%. And then you have, like, I mean, the expected cash flows after 1,000 years, so 100 years, so 22 years would be here. Okay, so, and you have the valuation equation there. How do you calculate then the price of, I mean, the imaginary firm that we had in the previous slide? Well, just I'm using a discounted cash flow model, using the numbers that we had in the previous slide. And now, how do we then get the discount rate that you would apply for all cash flows, basically? Well, of course, it's some kind of geometric average of those cash flows that I showed you previously. But one way to calculate that, or to approximate that, is to assume, like one of the simplest models, the Gordon's growth formula. and you can solve for discount rate here. So, okay, this is now the expected cash flow in year 1. It was €1. This is the price that we calculated. And then let's assume, then we need to assume a growth rate for dividends. Here it is 1%, so let's put it here. And we can find, okay, it's 8.56% for this group of firms. But if you do it for both groups of firms, I mean, those having the lowest expected rates of returns, those having the highest expected rates of returns, you can actually see that the implied discount rates for these are actually fairly close to each other. And this is actually a number you should be using when you are valuing equity, right? So it's basically, the discount rate that you can apply to each and every period. So 8.56 raised to the power of 1, 8.56 raised to the power of 2 for year 2, and of course basically 1.0856 raised to the power of 1 raised to the power of 2, and so forth in those different, denominators for those different terms. And if you assume a different growth rate, like 5% growth rate for dividends, then you can see that actually this dispersion is even smaller. Okay. Some results. Using assumptions about the expected stock market return 10%, growth rate 1% in dividends. So same numbers that I showed you in the previous table. You can see now the distribution of this annual cost of equity, calculated in a way that I just showed in the previous slide for all those 300 groups of firms. And you can see that, first, it's fairly symmetric, this distribution here. But if you then look at these numbers, so you could say that, okay, 95% of firms using these parameter values, have their cost of equity, minus 1.38 for the market-wide mean, and this largest group has their cost of equity 1.51% units on top of the market expected rate of return. So this is like the so if you want to see the variation, you just take this number minus this number and then divide it by 2 basically. So how far away are we from the market average discount rate where we talk about 95% of the firms? And a standard deviation there also. Okay, so we of course made some assumptions about some parameters there, like the expected market return and growth rate of dividends. Well, what we know is, for example, that when expected market return decreases, then the cost of equity difference actually becomes smaller. And same thing happens when the dividend growth increases. And the reason here is that, okay, so when dividend growth increases, then these cash flows that will occur further away in the future actually get more weight in the present value calculation. And same thing, of course, also when the expected market return decreases, well, then the discount rate decreases, implying once again that, relatively speaking, those further away lying cash flows get more like weight in the present value calculation than what they would get if the expected market return was higher. And of course, because during those longer time horizons in the future, the discount rates basically, or period by period discount rates are so close to each other, and when they get more weight, those very similar discount rates, then of course the average discount rate for this whole stream of payments, becomes much closer to each other across firms. Okay, so what would then be realistic numbers? Well, there you see some statistics from the US, and you can see that the evaluated nominal return was 11.3% in the US using the CRISP value-weighted index. Risk-free rate 4.8%, which implies that we are right now living actually in fairly normal times in a sense. And then the dividend growth rate was actually 6.1% across all firms in the US stock markets during this 60 year of data. And so you can pick your numbers. So we do some sensitivity analysis here. What you then see here is basically now the standard deviation of this implied cost of equity that we have calculated. We are still, no matter what assumptions we make here about the growth rate of dividends, expected market return, those standard deviations are, very, very small. So it seems not to be, I mean, so much affected by, or the main conclusion doesn't seem to be that much affected by you know, the assumptions that we make about these parameters. And here's just another example. So if you then assume that the dividend, okay, going back to the actual, I mean, closest to the numbers that we have in the actual data about dividend growth rate and expected market return, then you get, you know, results that basically lie here. So you can see that, I mean, there's not much of variation anymore in this cost of equities across all US stocks that we study here on average. Okay, so why do our results then, why is it actually, I mean, challenging conventional wisdom? I'll soon talk about that, but actually what I also want to say here is that, of course, this is just one piece of analysis that we do, especially in this practitioner-oriented paper. In the more academic paper, in the Journal of Financial Economics paper, we also do like a, so to say, a model-free from Macbeth type of estimation, the way we don't assume any drivers of expected rates of returns, but we actually regress cross-section of stock returns on past cross-sections of stock returns. And we basically find the same results there also. So the main conclusion is not based on just this type of analysis, but I'm very willing to, of course, answer questions related to that later on, if you have any. Okay, so let's look at analyst forecasts. I mean, there have been studies that are basically, that have tried to gather information about, so what cost of equity, you know, estimates analysts are on average using when they assign valuations to exchange-listed firms, and how much do they vary across, I mean, across the firms, and what they basically, what, for example, this paper by Balakrishnan and I'll find is that the standard deviation is about 2.35%, the cost of equity standard deviation across firms, which is about 6 times of the number that we find. And okay, they also find that the mean cost of equity is 10%. That sounds reasonable, but the range is actually from 5% to about 20%, which is actually a huge range if you compare to our results. Then you can look at what investment banks are doing. So of course, when there's an M&A deal, you know, whatever, I mean, they have to often, you know, publish these fairness opinions to the current shareholders, and then we can see what discount rates have been used. It's a fairly small sample because this hand-collected data, just for this Journal of Corporate Finance paper that we collected, but you can see that, like, I mean, the average estimate has a standard deviation, or the average, you know, that they use the cost of equity calculation for each firm. I mean, it's like standard deviation is 2.1%, which is considerably higher than what we find in the data. What is, however, interesting is that actually, if you look at the high estimate and low estimate that you find in the data, then I mean, there is actually not that much dispersion there. So this seems to be fairly reasonable numbers that investment banks are actually using, though the variation is maybe a bit larger than what we have found in our analysis. Right. There's also an earlier study that does that. Of course, courts, whenever there's a litigation case or, you know, some other case where, you know, attorneys, with the help of experts, have to come up with some valuations for firm. Of course, you need a discount rate for those valuations, and then we see that, okay, most often experts, and we know analysts, of course, also do this, they use the CAPM to calculate the discount rate, so the cost of equity capital, and there seems to be a fairly, I mean, high variation once again in these cost of equity estimates that are being used in courts also. Yeah, it's interesting actually that CAPM is used so often, because we know, well, it is difficult to pin down, I mean, the correct cost of equity capital, no matter what model you are using. But if you know that the CAPM actually fails empirical, as it can't explain almost anything in empirical research, then the use of the CAPM is, well, maybe a bit not always something that one maybe should be using, but nevertheless, and so forth and so forth. So you can, I mean, you can make several of these surveys and ask firms what they think about their own discount rates. So if you serve, so there's a survey by Ravi Jagannathan and his co-authors they survey 86 firms, and they find that the standard deviation of these firms' self-reported weighted average cost of capital is 4.62%. And we, assume that, okay, 0.4 would be a reasonable number. Of course, weighted average cost of capital is not the same as cost of equity capital. It also contains, other costs of capital than just the equity cost of capital, but nevertheless. But then what is also interesting is that, if you then survey firms, so 50% of surveyed firms think the market risk premium is less than 3%. 50% think it's 6% or more. So there's, of course, in the shared parameters in all these valuations, there's a huge dispersion there also, what number we should be using. However, based on survey evidence, we also, 89% of firms actually think that they get the cost of capital estimations within like 1 percentage units from the correct value. So they feel that, okay, we are fairly reasonable numbers that we are using here. We are close to the actual number, whatever it might be. Textbooks, okay, so we could blame textbooks about these kind of things. Well, of course, most textbooks still say that you should be using the CAPM when calculating the cost of equity capital. Okay, well, but even if you assume that the CAPM was the correct model, that was a good model of risk and return, it still only gives you the 1 period ahead discount rate. It doesn't give you the 2 period ahead discount rate or the 3 period ahead discount rate. All these factor models give you the 1 period ahead discount rate only, which is probably not the discount rate one should use in valuation. Yeah. And often, when you have examples in this textbook, they often build a spread like this, in their examples, 4 to 5 percentage unit spread in the expected returns on 2 stocks whenever they have these numbers. And finally, if you look at the Damodara's book, which, is wonderful, his valuation book, he has a very, good analysis of the cost of equity capital. So he found, for example, in 2016 that 10% first with the lowest cost of equity capital had a cost of capital of 5.23%, and 10% of the first with the largest cost of equity had a cost of equity about 10%. And he then states that, okay, the spread in cost of capital is surprisingly small. It's still, however, about 4 times larger than the one we estimate from the data. And of course, the reason is that the way we do the analysis is slightly different. And one good argument that Damodara then makes, for the case of why discount rates, of course, equity capitals, should not differ that much across firms, is that firms tend to change over time. And this is actually also financial economics paper. In a short run, so let's assume now that value firms have higher cost of equity capitals than growth firms, which, in past data, that seems to have been the case if you start the analysis from 1920s and end it to today. So yes, that might be true. If you look at like the cost of equity or the discount rate that you would apply 1 year to the future or 2 years into the future, but as firms change, their cost of equity capital should also change. And if you are like, in either one of the legs of the distribution, if, for example, you're an extreme value firm, you're an extreme growth firm, you are most likely not to be that extreme anymore after 5 years, after 10 years. It's very likely that in this value growth dimension, both of these firms will be much closer toward the mean. Same thing with small firms. Small firms tend to become bigger over time. And they, and of course, there are the new firms entering the market, and some firms, become smaller. So firms do change over time, leverage changes over time, beta change over time. So, and since there's a reversion towards the mean in all these firm characteristics that we often think are connected to variation expected rates of returns, then it should come as no wonder that as time flows by, first become more first move in their characteristics, in the characteristic space closer towards the mean. Then of course also their cost of equity capital should approach the mean. And this is what we define in the academic paper, JFE paper that we published, that this is actually what is driving now this convergence in discount rates. So, of course, I mean, it's a very, I would say, so we are challenging conventional wisdom here, and and of course, one should always take each and every individual piece of research with a grain of salt. However, I mean, there are some papers that have, by other academics, that have then continued on the work that we have done in our paper from a couple of years ago, and they tend to find, I mean, the same types of results. But of course, I mean, after 10 years, we probably know much more about this topic. So whatever suggestions I now give to you, I mean, so you should, of course, think deep and carefully about what you want to do with it. Maybe you should do, I mean, look after 10 years of what we know at that point. But of course, I mean, so when you estimate the cost of equity capital across firms, even if you don't believe that the numbers should be roughly the same across different listed firms, it's still important that if you find a very outlierish value there, it's a good idea to shrink it more towards the mean, right? And knowing all the problems there are with the cost of equity estimation, knowing that it's one of those parameters that's so easy for analysts, I mean, to tweak a bit to get to the valuation that they find is more appropriate for a given firm, it might not actually be a bad idea to get to just use the market-wide average, like the expected rate of return on a stock market for the firm. I mean, yeah, I don't think, I mean, you make a huge mistake if you assume that firms have approximately the same cost of equity capital. And what also means is to be more important here is that given, of course, all the difficulties in estimating this cost of equity capital, what model should you be using, and all these problems that arise with it, I mean, the uncertainty that we have there, and of course, also considering the results that, hey, it might not be that different across firms even to begin with, then it might make more sense to put most of the weight in your analysis and try to forecast the expected cash flows, free cash flow to equity or whatever, or dividends or whatever, as well as possible, instead of spending too much time thinking about this long-term discount rate that you should use in valuation. Right. That's about what I had to say about this topic. Thanks for listening, and I'm eager to hear some questions if there are any.
Yeah, thank you, Peter, for explaining your research and your conclusion and some suggestions. Yeah, any questions? I can't see questions in the chat so far. Any questions from the audience? No questions.
It's a very difficult topic to ask any questions about, because it's a shock to most people, I suppose.
Solomon. Chanda, can you?
I'm sorry, Wolfgang. We have that?
Solomon would like to speak, I think.
Oh, I didn't see that. Let's see. Was that sent to you privately? There's one from Todd Phelps. Do you add a company-specific risk factor? I don't see the message from Solomon, though.
Oh, there is he raised the hand.
Oh, okay.
So.
All right, let me see if I can unmute. Solomon, you raise your hand. I'm gonna allow you to speak. So let me unmute that. Let's see.
Unmute. Hello?
Hello.
Hello? Yeah. I'm on now. Hello?
Hello, you can speak.
Yeah. Okay. Now, if I look at the rates that was shown in calculating the discount rate for year 2 and so on, it assumes that the discount rate after year 1 is going to increase in future. Is there a possibility that you can get a scenario where the discount rates will be reducing? Because in certain quarters I've seen, the rate of return tend to rather decrease with increase in time.
Yeah, so when you say that the discount rate increases over time, you're probably referring to the fact when you look at those firms that start with low discount rates for year one, their discount rates tend to increase over time. And then, I mean, those firms that have high discount rates in year one or high expected rates of return during year one, I mean, their discount rates tend to decrease over time. So like they seem to be converging towards the common mean. So that's probably, I mean, what you are referring to in this case. So I mean, it can go in both directions, but it basically starts. I mean, it depends on where you start from. In the short-term discount rate distribution, you start in the higher end or in the lower end, and then it would go towards the mean over a slightly longer time period. Did that maybe answer your question, or?
Yes, somehow. I think that we'll have to rely on the geographical occurrence of discount rate, depending on which industry you are looking at. And then, in addition to that, at what rates are the banks borrowing corporations within the certain geographical area? I think that would be useful.
Yes. I mean, certainly. I mean, I'm fairly sure that if you then were to look, for example, across countries on this discount rate dispersion, probably would find, I mean, country level differences there. So of course, we did this study only using US firms and US markets, where you might assume that, okay, there's like some kind of mean discount rate, but it's clear that, I mean, if you go to other markets and other countries, then there are country-specific risk factors which tend to affect firms that are listed in that country. Yes, absolutely.
Thank you very much.
Thank you. There were some questions in the chat which relate to similar topic. How do you use company or country specific risk factors, or do you use company specific risk factors?
Yes, in a sense, yeah, because we use these company specific characteristics to sort stocks into different groups, and they contain then also company specific risk factors such as leverage and those types of things. So yeah, in a sense we do, but not of course country specific because I mean it's only in the US.
Yeah. Okay. One more question is mean cost of equity a better measure than narrow average, as this would remove outliers?
Narrow average. So what would that be referring to? I basically saying shrinking towards. I mean,
okay.
Yeah. So I guess, I mean, so if you have like a discount rate distribution and okay, so let's assume that you do, for example, the CAPM estimation, security market line estimation for different firms, so then you find a large dispersion maybe in the betas and then in the implied cost of equities for these firms. Yeah, so one possibility would be that you use just a market-wide average, or then of course you could assume, okay, let's shrink like this distribution so that, I mean, if the market-wide mean would be 10%, then maybe we should just discount rates from 8% to 12% within that band. So those discount rates that are above it would get 8%, would get to 12%, and below 8% would get 8%. So that's of course one possibility also, if you want to have a spread there, just to make sure you know that you still have enough variation in those discount rates. So yeah, that's of course something one could do based on our results.
There's another question from Tom in the Q&A. How much should my company exceed the required rate of return on the S&P 500? I mean, the S&P hits 80 to 21 on average PE ratio.
Mm-hmm. Yeah, let me just see. Was it in the early beginning of this chat, or?
This is in the Q&A.
Oh, Q&A. Okay. Oh, there. Sorry. Yeah. First time I use actually Zoom webinars. I'm not on the S&P. Yeah. So it was again depends basically on, I mean, how you calculate the required rate of return. So of course, I mean, we do have these different, you know, different like valuation measures and stuff like that. But if you look at the long term, I mean, mean stock return. So basically, in order to estimate it in any way more precise, you need to have a long time horizon. Then that would be about 10% in the US at least. So if Tom is P ratio, right?
P ratio.
Yeah. So if assuming that the discount rate, basically, I mean, we also know that the cost of equity capital, it tends to vary over time. So if it's 10% on average, it's probably not 10% all the time. So I think, I mean, it might be a good idea to try to then, according to our results, I mean, nail it down to what you expect the S&P, required rate of return to be at this given moment. But yeah, assuming that you're a publicly listed company, of course.
Okay, so we have two remaining questions, which leads to the same direction. And one is, do you think that smoothed beta like Bloom adjusted betas are sufficient to provide this shrinking in cost of capital, this mean reversion? This is one question, and the other leads in the same direction. Would it be a practitioner way maybe to use different cost of capitals, split it between the detailed forecast period and the terminal value? Maybe we could use a beta of 1 or market average cost of capital in our terminal value models. And if I remember your graphs, starting year 6, 7, 8, 9, 10, every difference seems to disappear.
Exactly.
So most of practitioners' forecast periods are between 5 to 10 years.
Yes.
So it would be a rational conclusion to say, okay, let's use maybe CAPM. We all know the limitations of CAPM as a single factor model. But okay, let's do it or modify CAPM within the first 5 or 10 years. And in the terminal value world, we use market average cost of capital.
That is a very good point. Yes, I suppose, I mean, that would be a correct implication, because in the shorter run, as you mentioned, I mean, there seems to be differences in discount rates, of course, of equity capital, like for those given, I mean, time periods, those given years, I mean, from year 1 to 5, maybe even up to year 10, but I would basically cap it at 5. But then, I mean, but after that, I mean, for the terminal value, it would certainly make sense, in my opinion, to use like the market-wide average just there. Okay. And also because it's so very difficult, I mean, to predict like what is the cost of equity capital after, let's say, 20 years, so whatever, so it's most likely not what it is today for the next year or stuff like that. So very good point, And then sorry, Harry had a question. So do you think the commonly used smoothed beta is sufficient to provide shrinkage in the cost of equity towards long-term mean level? It's better than nothing. Absolutely, yes. I probably would smooth it even more than what Bloomberg and these providers are smoothing it. But yeah, it's certainly better than using betas that they would estimate without any smoothing.
Okay.
It's probably not sufficient, but yeah, it's better to use those nevertheless.
And Harry also is asking, what is your take on the use of a size premium in addition to CAPM?
Yes, that's again one of those questions that had you asked me that had I been active like 20 years ago, when I wasn't, but I probably would have said that yes, you should probably add like a risk premium for small firms. But then again, if you look at data starting from 1980s and going back, coming back now to current day, there doesn't seem to be that much of a size premium anymore in stock market. So small firms have not outperformed large firms during the past 40 years. And of course, we know most recently, the last 10 years, I mean, it's been quite the opposite actually. Which of course, I mean, 10 years is too short of a time to make any valid conclusions still about what I mean will happen in maybe in the future. But I probably would say that maybe not any more to add a size premium there, based on empirical, I mean, studies at least. But then again, of course, you also have to think. I assume that you also have to. I mean, do what you feel is sensible. For me, it sounds more sensible that smaller firms are, in a sense, more systematically risky than larger firms. And even if our, estimations tell you that, okay, it doesn't seem to be valid in the data anymore, then, yeah, I mean, you could motivate using a small firm premium there also, based on those arguments.
Penty from Ghana is asking, how is financial leverage factored into your cost of capital analysis, especially as it will vary between larger firms and smaller firms?
Yes, that's once again a very good question. So we don't actually take explicitly into account financial leverage here. What we know, looking at stock returns only, is that financial leverage does not actually seem to affect expected rates of returns, which sounds strange, but that's just something that we find in the data. So it's not direct. So leverage is one of the characteristics that we use when we sort firms into these different groups, but we haven't really, I mean, thought about like the cost of capital at the firm level, which of course would then include the cost of debt, and that's because then it would of course imply because we know that the cost of debt should be, or theoretically speaking, smaller than the cost of equity capital. If the cost of equity capital doesn't vary much, it should imply that the real cost of debt shouldn't either vary that much, which is not basically what we see from yields on different corporate bonds. So yeah, that's one step I've been thinking about that we should study in the future. One thing, certainly, yes.
Okay, perfect. So let's have a look. Let's have a final look. I don't see any remaining questions. So perfect
time.
So now I have to work on my valuation model to allow to set a different beta in terminal value. So, but I think it's an easy thing to capture this.
I think so. Yeah.
Thank you very much, Peter.
Thanks. It was great being here, and we enjoyed it a lot. And of course, if anyone attending this seminar, if there are questions, you can send me an email always. I mean, we're willing to carry on conversations also more in private then. So,
okay,
that's great.
That's perfect. Yeah, thank you, Chanda, for the technical support. Our next Around the Valuation World show will be on December 11. Take care and stay safe and have a great evening in Europe. So thank you. Thank you, Chanda. Thank you.